And the third rule when we're purchasing options is we use what we call the 1% rule to select the option strike price. And if you use the 1% rule and select an option strike price that only requires the stock to increase in price 1% or less in order for the trade to break even and start profiting. So with the 1% rule, we like to limit the time value portion of the option to 1% of the stock price. And if we do that, the stock only has to go up 1% and we start profiting. So once you select an option trade, there's hundreds or even thousands of strike prices to choose from. So we use this 1% rule to help us select the strike price. So option premiums, of course, consist of time value and intrinsic value, and options lose all time value at expiration. So when you buy an option, you're buying a decaying asset. And due to these time decay characteristics, when you're buying an option, we want to minimize the time value because that's going to decay to zero, and we want to maximize the intrinsic value. So what we do is we simply limit the time value portion of the option to less than 1% of the stock price. And that will allow us to minimize the time value and maximize the intrinsic value. So as I mentioned, if you limit the time value portion to 1%, the stock only needs to go up 1%, and then you break even and start making money. So this will have a much higher probability of success than an at-the-money or out-of-the-money call that requires the stock to go up, let's say, 6 or 10% over a one-month period, which may not happen. And if it doesn't happen, then you lose 100% of your premium. So we like to use this 1% rule, and if we're wrong in an option trade, then we simply exit with about a 20% loss, and then that way we can move on to the next trade rather than incur a 100% loss and be wiped out of the game. So let's look at an actual example. This brokerage confirmation shows we bought the DVY, the dividend ETF, 70 strike call at 1170. And at the time, DVY was trading at 81.38. So if the stock was at 81.38 and we buy the 70 call, that's an in-the-money call. And if you subtract the strike price of 70 from the stock price, you come up with the intrinsic value. So we paid 1170 for the call, and the intrinsic value portion of that premium was 1138, and the time value was only 32 cents. So paid 1170 on the option premium, 1138 of intrinsic value, so the time value was only 32 cents. So in this trade, DVY only had to go up 32 cents, and we would break even on this trade and start making money. And this call option calculator shows the profit potential for this trade, assuming various price changes in DVY at option expiration. In this example, from a 30% increase in the DVY to a 5% decrease. And we can see that if the stock is flat, we'll only have a 2.7% loss as opposed to 100% loss for an out-of-the-money option. And we still have a decent return potential if DVY is up 5% at option expiration. This option purchase will have a 32% return. If it's up 10%, we'll have a 66% return. So even though we're buying in the money and it costs more, we still get a good return if the stock goes up. So let's look at, these are our current call option purchases. I just took this yesterday, and this column right here lists the percent gain. So the first option is Applied Materials. We have a 38% return. Amazon, we have a 25% return. Quest Diagnostics, 1%. DVY, we have a 186% return. Small cap ETF IWM, we have a 247% return. NVIDIA, we have a 6.4% return. That turned into a loss today because NVIDIA was down, but we have a spread trade on that, so that spread trade helped protect this profit in NVIDIA, and we'll look at that in a minute. In the QQQs, we have a 300% return, and in the real estate investment trust call purchase, we have a 24% return. So those are just our current call option purchases.